Welcome to the We Study Billionaires YouTube channel. I'm your host, Clay Finck. And this week, we released an episode on the We Study Billionaires podcast discussing the investment approach of Mohnish Pabrai. So I thought it'd be a good opportunity to revisit my colleague William Green's interview with Mohnish back in 2022. As you can see on the screen here, I have the interview pulled up with Mohnish and William here on our website. And if you're not familiar with our website, it's really helpful as we have all of our podcast episodes listed here. Here's William Green's Richer, Wiser, Happier episodes. Here's our We Study Billionaires episodes. Our feed to date has over 100 million downloads. Here's the general website where it shows all of our shows. We have We Study Billionaires, Bitcoin Fundamentals, Richer, Wiser, Happier, and then Millennial Investing in Real Estate 101. And then on our website, we also have an investment tool called TIP Finance. This is the tool I use to analyze stocks for my own portfolio. Now, this episode with Mohnish Pabrai and William Green was a very popular episode. The podcast had over 160,000 downloads, and the YouTube video, last time I checked, had over 73,000 views. If you haven't tuned in to our most recent episode doing a comprehensive deep dive on how Mohnish Pabrai invests, I'll be sure to get that linked in the description below for you to check out. It is episode 517 titled Mohnish Pabrai's Dando Investment Framework on the We Study Billionaires podcast. During that episode, I dive into Mohnish's investment framework of what he calls the Dando investor. Now, the Dando approach is really interesting and unique because he's looking for these obvious bets that offer high upside but very little downside. And this approach has led him to vastly outperforming the market, as his fund since the year 2000 has returned investors 781% versus just 378% for the S&P 500. So during this YouTube video, I'm going to be pulling some of my very favorite clips from William's interview with Mohnish and adding some color around my biggest takeaways from that interview. They talk quite a bit about living a good and happy and well-lived life during that interview, but this video is going to focus more on the investment side of things. If you're interested in those other parts, as many people obviously were, I'll be sure to get that episode linked in the description as well. If you like these types of videos and want more of them, please let me know in the comments section below. And while you're at it, please click like and subscribe so you can continue to get notified of these episodes in the future and continue to support the show. Now, Mohnish is widely known as what he calls the master cloner. He shamelessly analyzes every single aspect of the world's greatest investors, and he'll take their best ideas and implement those ideas into his own life and investment approach in a way that makes sense to him. Now, Mohnish purchased the Warren Buffett charity lunch with Guy Spear back in 2007. And to Mohnish's surprise, he's become great friends with Warren and Charlie over the years. So during this first clip, Mohnish was asked about the differences in Warren and Charlie's investment approach. Here it is.
Do you feel that Charlie is a very different type of investor than Warren? Like, what's the difference between? Because I mean, even something like Alibaba, right, or Costco that Charlie would own and that Warren wouldn't look at. Where do they diverge, do you think, in their approach to solving this game, this puzzle?
I think they obviously have a lot of similarities in how they invest. They used to talk a lot in their younger days, and I think those conversations have become fewer now because part of it is, they've had so much interaction, almost know what the other guy is thinking and such. I think Charlie got to understanding the importance of better businesses. Better to buy a good business at a fair price and a fair business at a good price. I think he got that understanding well before Warren, and I think it took Warren more time just because I think he's been so successful in the traditional Gramian approach, and that. One of the things that has, I think, a difference between them is when Charlie sees a tremendous business. I mean, they're both cheapskates and they're both not willing to pay up. But one of the areas, for example, where they diverged was Costco, right? And, Charlie tried to have Berkshire take a much larger position in Costco. And Warren's perspective was it's too expensive, right? And Charlie would always say, well, for some things you pay up, right? And so there was some divergence in a view there. There was also a divergence in BYD, So I remember, I think we may remember, I think Charlie told Warren that Chung Fu Wang is like Thomas Edison, and you should invest with him. And Warren just kind of ignored that. And then he said, well, he's like Thomas Edison and Henry Ford, both in the same person. And Warren still ignored that. And then Charlie told him he's like Thomas Edison, Henry Ford, and Bill Gates, all in the same person. And at that point, what Charlie said to me is he went ahead after I made that third comment, putting three people in one person, but he didn't use his own money. So what he did was, it's kind of like these people, like kids running a lemonade stand, the way they talk about it. He said he didn't use his own money. He went to David Sokol and had Mid-American Energy use their money to buy the stake in BYD. And so the $250 million that Berkshire Hathaway invested in BYD came from Mid-American, which I think at that time Berkshire owned 80% of, right? And then he put David Sokol on the board of BYD. And so Charlie said to me, in the end, he didn't even use his own pot of cash. He went to another pot somebody else controlled and said, okay, you do it from there. And of course, Berkshire would have done slightly better. I think now they have like 91% or something of Berkshire Hathaway Energy. They would have done a little bit better. It's been a major home run.
I mean, it's made billions of dollars, right? BYD for Berkshire.
They bought at 8 Hong Kong dollars per share, and it's at 260 Hong Kong dollars per share right now. And so this is 14 years and more than a 30x.
So there you heard it from Mohnish that Berkshire's investment in BYD made them a 30x return to date. Investments like these likely wouldn't have happened if it wasn't for Charlie. And I don't think that Charlie gets enough credit for this, as he's pretty well known for helping Warren making that transition to buying quality businesses rather than buying just really cheap businesses. But I think there's still that slight divergence between Warren and Charlie even today, where Charlie's more willing to pay up for quality businesses, where Warren is just putting so much more focus on the price, and he's going to be really sure that he isn't overpaying for a company. With that cigar butt style approach of buying cheap businesses that Warren has done over the years, you can earn good returns with that approach. But when you buy a great business and you're holding that business for a really long time, you end up saving a substantial sum of money when you continually defer your capital gains as you're just, extending your holding period longer and longer. Whereas if you're buying something cheap and continually trading in and out, you're incurring those capital gains taxes every time you're selling at a gain. Next, I wanted to play a clip of Mohnish talking about a business called Credit Acceptance, which offered loans to individuals who don't have the best credit, so they're charged really high interest rates. When Charlie Munger first heard about this business, it was a nearly instant pass, as it didn't fit his criteria of being a win-win business. And that is a win for both the customers and the business. I talked about this extensively during my episode covering Nick's Sleep, episode 492 on the We Study Billionaires podcast. Here's the clip.
But when I brought it to Charlie, he just said, we don't want to own that kind of business. And it took him less than 5 seconds. He'd never heard of credit acceptance before. I spent about, exactly what I told you, about 5 minutes on the business. And he'd already processed in his head. And I think what his perspective was is that one of the filters that he runs through is win-win-win. Everything has to be a win across the board. And I think what Charlie saw is that the high interest rates is not, even though you could justify it 100 different ways, he just said it's not the kind of business we want to be in, right? So his bar is just high, right? And I had been looking at that for several weeks, and that particular point never made it through to me. And there are lots of really high quality investors who own credit acceptance. In many cases, it's their largest position. And, so it went through their filters. It never went through Charlie's filters. And so that's, it's just an amazing brain. Just to see, so many times I brought up questions to Charlie. I'm facing fork in the road issues at Dakshana, and I'm kind of torn about what to do. And I explained the issue in about 5 minutes to Charlie. He's never been to India. He comes up with an answer, and it's always the perfect answer. I said, why didn't I think of that?
If I were to give an example of what a win-win business might look like, the first place I'd look is Nick Sleep's portfolio. Sleep's portfolio is primarily invested in 3 companies: Berkshire Hathaway, Costco, and Amazon. Focusing more on Costco or Amazon, these businesses are focused on offering the lowest possible prices. Once people realize that Costco is absolutely committed to offering the lowest prices possible, that continually attracts more and more customers to Costco. And since Costco has all these customers, they have this tremendous bargaining power with suppliers, which then enables Costco to offer even lower prices. So it turns into this flywheel effect where the customers win, the shareholders win, and the suppliers win. And then Costco is also known for treating their employees really well too, and having that strong culture. So Munger is looking for these win-win type scenarios where all parties involved are better because of that business. Next, I'd like to play a clip about how Mohnish recognizes that he's going to be wrong on at least half of his investments, and that even achieving a 50% error rate can lead to an incredible investment track record. It's a good reminder that we shouldn't become married to our investments. And when you discover that one of your investments isn't playing out near how you expected, sometimes it's best to just get out of it and find better use of that capital.
I'm struck with you, Mohnish, about how many times I've seen you do something that you have a very high conviction about, and you think, this is a fantastic idea, and you tell me and other people what a brilliant idea it is, and we're all totally sold on it. And then a few months later, you're like, no, didn't work, and you're very unsentimental about it, and you change. I've seen you do it with things like Seritage that you owned, or Alibaba, or this insurance business that you were running. And it strikes me actually as one of your great strengths is it is kind of strong opinions lightly held. There's this willingness to change. Can you talk a bit about that? Because it seems very fundamental to the way you operate.
Yeah, so I think, if we go back to John Templeton, he would say that the best analyst would be wrong 1 out of 3 times. And in fact, he was a mentor to Prem Vatsa at Fairfax. And Prem would go to Bahamas once a year to spend time with John Templeton. John Templeton told Prem that if you're wrong half the time, you're going to end up with a tremendous track record. Okay. And so one of the things we have to remember about investing is that the error rate, even for the best of us, is going to be really high. And this was one of the reasons why Charlie told me to talk to Lilu. It was one of the reasons why. And in fact, he said to me recently, he said, I remember one time he told me, he said, so you bought Mautai? I said, yeah. He said, good. Okay. And then recently he said to me, you and Lilu collaborated on Micron? I said, yeah. He said, the idea came from you? I said, yeah. He said, it will do very well. Okay, I said, it's great to have God give that kind of endorsement because I didn't get that in the insurance business from him. And so I think the thing is that this 50% error rate, we have to be really cognizant of, and we have to be humble about it. And so you're right, I get excited about things. And this is the nature of investing, is that greed takes over our brains. We look at this company, we look at the upside, and the greed takes over. And we have to have artificial mechanisms to damp it down. Talking to someone else is a way to damp it down. Having a checklist is another way to damp it down. Having somebody who actually has a completely opposite point of view and talking to them is another way to dampen it. So we need circuit breakers with all our investment ideas. because the animal spirits will run wild. Because you would see, I just today, in fact, I came across a business that I really like. I still have to drill down on it, but at this point, I can't see what would be wrong with it. But I haven't done the work yet, and so it'll be really important for me before I do anything with it is to run the checklist, talk to others, and just really try to get a rounded view, and then see whether I still want to do something with it or not. So I think that there are two things that are important in investing. One is that we have to be very cognizant about the fact that this is not brain surgery where 3% error rate is bad news. You're going to have a high error rate. The second is that when you are right, you can be really right, and you could have a 10 bagger, 20 bagger or something, which would, cover a lot of sins. And the other thing is to have the humility to realize when you have been wrong. So Heritage is a good example where I thought that I looked at it and ways to Sunday and it was going to work. And then I finally came to the conclusion that no, there was an error. There was an error in my analysis, and that it was going to be some pretty heavy lifting to make it work the way I thought it should.
One of the things that sticks out to me in studying Mohnish's investment style is how it differs from someone like Charlie Munger. Mohnish very much wants to find something that is just so obvious to him, and he wants to find something that he believes offers that asymmetric return, which leads him to looking for a stock that's just relatively cheap, similar to what I was talking about with Warren earlier, rather than searching for something that is very high quality, which is what Charlie tends to look for. I believe this shows that we need to find the investment approach that makes most sense to us individually, and the strategy that allows us to build that conviction and be comfortable with what we own. I tend to side more with Charlie personally, as when I find a quality business, I'm willing to pay up a little bit for it and let the investment thesis play out over a long time horizon as the business effectively redeploys its capital over time. Related to this, here's a clip of Mohnish talking a bit about how his template to life and investing is going to vary from Warren and Charlie's.
You try on this Buffett glove and it fits. It looks like it fits really well. And you say, this is it. So then I can just look at Buffett and just clone everything about him. And then that's me. And now I'm, in a nirvana state. And they said, that doesn't work. They said, it's almost for sure that the template that makes up Buffett and the template that makes up Mohnish are not the same. It may be similar on a number of traits, but it's not the same. So like, for example, what I found when I heard about Buffett in 94 is I had been playing bridge for 6 or 7 years before I heard about it. I love bridge. Even now I play many hours of bridge every week. And I said, look, there's a similarity with bridge. There's a similarity with analyzing businesses. There's a similarity with investing. I seem to like all of that. Everything seems to fit. And they said, it's not there. And they said, what really needs to happen is that you need to understand who you are and to be true to yourself. And part of that owner's manual helped me look inside to see who I was. And I've reread that many times. And what I've realized over the years is that, yes, they were absolutely right. It took me a long time to see this, that Warren Buffett is a very different person than me. There may be some areas of similarity, but there are vast areas of differences. And those vast areas of differences are not easy for me to bridge. If I were to try to do that, first of all, it would be a distortion to try to do that because I wouldn't be true to myself. So it wouldn't even work. And so I think this notion you bring up about the kindness and so on is even when I read Hawkins, I took the stuff that was easy for me. Right? I mean, I'm always looking for low-hanging fruit. I'm always looking for the shortcuts. And I said, okay, this, being ethical and truthful, I can do this in my sleep. It's easy. The kindness is a much harder thing to do. I have learned over the years to become kinder and to be kinder. But I think I have a long ways to go. I think I have a lot of wood to chop over there. And so since there's 22 years and 3 weeks left, maybe I'll pick up Hawkins again and give that another whirl.
All right, those are the 4 clips of my biggest investment takeaways from William's interview with Mohnish Pabrai. I've recently released an episode covering Mohnish's investment framework of what he calls the Dondo investor. It's a whole hour-long deep dive covering how Mohnish finds investments with high upside but very little downside. You can find that episode on the We Study Billionaires podcast feed, episode 517, titled Mohnish Pabrai's Dondo Investment Framework. If you enjoyed this video, be sure to hit the subscribe icon below and leave me a comment and let me know what types of topics you'd like me to cover in the future. With that, I'll see you again next time. I wanted to start posting a little bit more on YouTube, and during this video, I wanted to talk a little bit about how I invest in individual stocks myself for my own portfolio, as well as give an intro into value investing in general, which I believe is really the most reliable way to build wealth in the stock market.